morning, everyone. Hope you're all doing great. Welcome to the next session of your financial management. I hope you've all done your homework. So quickly submit your answers in the chat box. Activity 4, the one on the screen, was your homework. So quickly pour in your answers, please. You were required to calculate return on capital employed, interest cover, as well as total shareholder return. So quickly pour in your answers in the chat box. I am waiting for your answers. Once I get the answers, then I will start to do the answers with you together. So quickly. Guys, if you don't do the homework, it's going to become very difficult for you to be able to, cope up with the pace at which the curriculum is going to go. Because definitely there's a lot to be covered and we need to do simultaneous question practice. There is absolutely no two ways about it. So can I have the answers? Any problems you guys faced? You were not able to do it? Please let me know. Okay. I hope the screen is visible though. Guys, you have to talk to me. You have to tell me. Okay. So Vinaya says return on capital employed previous year 25.7, current year 27.4. And other details. And what about others in the class? Are you not comfortable in being able to solve these basic ratios? Because if that is the scenario, it will become very difficult for you to be able to cope up with the financial management syllabus. So you really need to revisit your ratios. This is basic class 12. Okay, wonderful. Answers pouring in. So that's just great. What we will do it together. I will do it with you. And then we will ratify your answers. Okay, wonderful. So let's quickly have a look. Let me also open up my book. So what do we have here? First thing we have to calculate what? We have to calculate the return on capital employed, interest cover, as well as total shareholder return. Okay, so I'll get that done. So we've got two things. We've got previous year. We have got current year. I'm just opening the physical book with me so that I can just quickly pour in the figures from the book. Okay, so what do we have? Let's quickly calculate the interest cover first. So how much was your profit? Let me just highlight that. So profit before interest and tax, 8,700. Interest paid is 1,200. Can you calculate the interest cover? Yes, you can. So which is 8,700 divided by 1,200. Remember, interest cover is always given in terms of times. So this is 7.25 times in the previous year, and current year is 9,500 is the profit before interest and tax divided by the interest paid, which is 1,000. So 9,500 divided by 1,000. So that makes it equals to 9.5 times. I hope everybody is okay with this. Everybody was able to calculate this. Let's calculate the return on capital employed now, which is obviously equals to your profit before interest and tax. So that is 8,700 divided by your total shareholders funds, which is including the long-term debt as well. So which is going to be equals to 22,600 plus 11,300. So that is 8,700 divided by brackets 22,900 plus 11,800, is it? Let me just check from the book. 22900, 11,300 and 22,600. Sorry, 22,600 and 11,300. That's why I need the book with me to just quickly check. Okay, so that makes it equals to, and this is always in terms of a percentage, so that makes it equals to 26%, or we could open it up to one decimal place, so that is 25.7%. Similarly, do it for the current year as well, so that is equals to what, 9,500 it was, right? Divided by your total capital employed, which is 25,700 plus 9,000, 25,000 plus 9,000. So again, I'm just going to do a percentage, which is equal to 27.4%, right? I hope everybody got that right as well. What's the other thing that we need to calculate? That is, okay, these two we have done. Total shareholder return. Okay, so TSR is what we need to calculate now. Total shareholder return. So let's quickly calculate the, for that we obviously need the share price, right? Do we have the share price given to us? Let me see if we have the share price. I don't think so. It's given directly. Okay, so PE ratio is given. So can I calculate my share price? Yes, I can. Number of shares is also given to us. And also profit after interest and tax is also given to us. So we have all the information available to us for which we can calculate our share price. So PE ratio, which is 17, multiplied by my profit before interest and tax divided by my total. Okay. Apologies for my incorrect application. There is, so that is equals to 5,100 divided by 9,000. So profit after interest and tax divided by my number of shares in issue, which is equals to 9,000, and P multiplied by PE ratio will give me the share price. Similarly, do it for the current year as well, which is PE ratio is 18. Profit after interest and tax is 5,700. Number of shares in the issue remains to be still 9,000. So quickly calculate here as well. So which is equals to 18 multiplied by brackets open 5,700 divided by number of shares, which is 9,000, which makes it equals to 11.4. So my share price has risen from 9.6 to 11.4, which makes it equals to, and how much dividend has been paid? Dividend payable is 2,000 in the previous year and 2,200 in this year. So growth is actually how much? My growth percentage in terms of dividend, can you calculate? So let's calculate our dividend growth, which is equals to 2,000. My growth is there. So dividend percentage in terms of numbers is also given. Let's calculate my total shareholder returns. So my increase in, or I can just do it directly as well, but I could increase in share price. Just makes it easy not to do too many calculations together and separate them out. That just makes it a little easy. So that's equal to that. So how much is the number of shares which have been paid? So shares paid, increase in share price, that is P1 minus P0 is equals to 1.8. What we've just calculated, plus my dividend, which is equals to how much? Dividend per share, 0.244, and divided by my basic start P0 price, which was equals to 9.6, making it equals to, in terms of total shareholder return, equals to 21%. 20.9 or 21%, you can round it off. That's wonderful, Palak. Vinaya has also got that right. Gograj has got ROCE right as well. Wonderful. Let me just check the others. ROCE previous year is also correct. Gograj, well done. 25.66, 27.38. Wonderful. That's correct, Palak. That's correct. Vinaya, Vani, Sneha, Vinaya. Wonderful, guys. I'm so happy to see that, yes, you are all familiar with these basic ratios and you're able to go one level up by calculating the total shareholder return, which is something new that you've learned in your financial management classes. What about the others who have not responded? Is this okay with everyone? Any doubts, guys? Please ask. It's a very, very basic level question, but will definitely get asked as a 2-marker. So you should be able to calculate this. Any doubts? Anything anybody would want to ask here? Anything you want me to repeat here? I'm more than happy to do so. Please ask if you have any doubts. I'm waiting for your doubts or your go ahead. Okay, so looks like there is no doubt. Guys, I'm again giving you time. Please ask if you have any doubt. Please ask if you want me to repeat anything. Please ask if you want me to show you the calculation once again. I'm more than happy to do so. Because then we will move forward. So this part we have done. So that was a good question practice, not for profit organizations also we had touched upon. So we can very quickly go ahead and do activity 5 as well. So quickly do your activity 5, submit your answers. Which of the following statements is true? Okay, so let's see which of the following statements is true. Okay. So the agency problem is not important for the public sector organization because there are no shareholders. No, that is not right. Okay, what I'll do, I think the agency problem per se, we've not discussed as of now. So I'll come back to this question once we are done with the topic. Don't worry. I think that is why a little bit confusion in the answers is also there because we literally have like not touched upon the topic. So my apologies. Apologies. I should not have shown you this question. We've done value for money, but we've not done the agency problem as such. So, but the question has statements revolving the both. So we'll come back to this question, don't worry. So let's first understand who are the stakeholders of the organization. Everybody knows who are the shareholders, right? Shareholders are the people who own the organization, who have invested in the equity shares of the organization. So they are the shareholders of the organization. Now, let me ask you a quick question. The shareholders are the owners, right? But are they the one who are, managing the organization, taking important decisions for the organization day in, day out? Are they the ones? No, right. So then who is managing the organization day in, day out? Who is taking care of the operations of the organization, the decision making of the organization on behalf of the real owners of the company? So who is acting as agents of the real owners? Yes, well done, guys. It is the board of directors of the organization. So clearly, there are a different set of people who own the organization, who are the shareholders, and a different set of people who are actually managing the organization and taking decisions for it, which is the board of directors. Now, clearly, because there are two different sets of people, their objective from the organization, what they ultimately want from the organization, is also going to be different. What is it that the shareholders would want from the organization? Tell me. So I have today invested, say, 200,000 lakhs in any random company, and I would expect what? Maximization of my wealth, right? Not profit per se. We've already discussed that profit is not the correct parameter. So we say shareholders' wealth maximization is what the shareholders want, right? Right, Mitul Vani? So as a shareholder, you want your wealth maximization. Perfect. However, as a director, who are directors? They are ultimately agents of the shareholders, right? They are the ones who've been employed by the shareholders to act and make decisions in a certain capacity. What would their objective from the organization be? So I'm here employed to manage somebody else's money because of the experience and the expertise that I have. So what would my objective from the organization would be? I would obviously be more interested in my own big fat bonuses, my own big fat salary. So my own payouts, right? Yes, increase in the salaries. So we clearly see that there is a mismatch of objectives between what the owners really want and what the people who are managing the organization, the agents of the organization, what they really want. So this gap between the owners and the agents of the company is called the agency gap. And that is where we need to align, we need to put in measures to be able to align these two gaps and reduce these two gaps, so that ultimately the directors are also moving in the direction which the shareholders of the company want the company to move in. So that is what broadly the agency problem is. I'll come back to it later. But first, now it's very clear that an organization is certainly more than its shareholders, right? There are people who are connected with the organization. There are people who are internal to the organization. So there are a group of stakeholders who are internal to the organization, like the employees, the directors, the managers of the organization. They are working from internally within the organization. Then there are people who are connected with the organization, connected because they get impacted by the performance, by the decisions, by what is happening in the organization. And this includes the shareholders, the people who have given you debt, the customers, the bankers, the suppliers, the competition itself. So all of these are groups of stakeholders who are connected with the organization. And then there are some external stakeholders to the organization who are not very directly impacted by what you do and how you do your business, but are there who get impacted by the organization as long as you're complying to their rules and their regulations and their do's and don'ts. They are fine. Otherwise, they are high pressure groups. They are high, you can say they're a powerful group of stakeholders who can impact the organization's operations as well. So the government, the pressure groups, the local community at large, the regulatory body to which you need to comply to, or the professional body which you need to comply to, these are all external stakeholders. Stakeholder means that they have some shares in the organization. No, shares are only shareholders. So people who hold shares in the organization are called shareholders. Stakeholder is a broader group of people who are more than just the shareholders. They, even if like the employees may not be holding shares in the organization, right? The suppliers may not be holding shares in the organization, but they are connected to the organization. They are impacted and get impacted by the performance of the organization, by the decisions of the organizations, and thus are a broader group of people, broader than just only the people who own the shares, who are called shareholders. Right, Vani? Wonderful. What I'll do, I'll show you a quick video as well to help you understand this concept. I'm just sharing the link with you in the chat box as well. And let me share the sound in Zoom. Okay, so quick video.
In business.
Quick video for you to quickly revise the concept of stakeholders.
Presented by eduxit.com. In this video, we are going to enlist stakeholders in business. Stakeholders refer to different segments in the society who have direct impact on the business decision-making process and can directly impact the marketing performance of the business. Various groups that fall into the category of stakeholders are as follows. Clients or customers, community groups, employees or staff, financial institutions, government, local communities, media, shareholders, strategic partners. Maintaining good public relations with all the stakeholders help the company to increase the goodwill and in turn will help in improving the business through referrals. That covers the enlisting of stakeholders. Thanks for watching. Edixit.com is started to promote effective and efficient learning process.
Okay, so what do we have here? Yes, we have a group of people who are connected, who are there with the organization internally, externally, or are in some way connected to the operations of the organization. Now, we all know that there are different stakeholders, and definitely every stakeholder will have its own set of expectations from the organization as well. So let me quickly ask you this. As a shareholder, we've already discussed that you would want profit or shareholders wealth maximization. The directors in turn want their own remuneration, their power, their esteem, their lifestyle to be maintained from the company. What would employees of the company expect from the organization? Tell me. If you're an employee, what do you expect from the organization? As a stakeholder, you're a stakeholder, right? You have certain expectations from the organization. So what would you expect from the company that you work for? Regular pay, handsome pay, good working conditions, good salary, good working place, good work-life balance, job security, perks, isn't it? So yes, this is what the employees would want from the organization. What about if you're a creditor of the organization? If you have, lent some money to the organization, what would you expect from the organization? Obviously, you would expect your regular payments to be made to you. Yes, your EMIs to be paid to you, timely payment, regular payments. You would want security in return of the cash that you are giving. Yes. So all of that would be your expectation from the organization. What if you're a trade creditor? So you've allowed the company to take supplies from you on credit. So you've given away your goods because that needs to be used as supplies in the organization, but you've not taken the money. So you're a trade creditor. You would obviously want timely payments to be made to you. You would want, I've allowed 20 days of credit. I need to get my repayment done in 20 days, right? I need to get my credit sales recovered in 20 days, really. What about the community at large? What would the community at large expect from the organization? So here I'm talking about, not dumping waste in the nearby lake, making my environment as clean, as healthy as possible, not too many CO2 emissions being made, green environment, community development. Yes. So what we clearly see here is that, yes, there are many stakeholders, and each stakeholder clearly has their own agenda, clearly has their own set of expectation from the organization. And sometimes these expectations are, literally going in different ways. One is pushing the organization to keep maximum payouts, the other probably wants the organization to invest in protecting and in keeping the environment healthy at large. So these are contradicting, you can say, expectations as well. And thus we see that it becomes difficult for the organization to be able to manage all stakeholders. So as an organization, I need to be able to manage my entire set of stakeholders, keep them happy, keep them satisfied, keep them informed. But yes, some sort of stakeholder management is definitely required. Then we have a look at what is called as the agency problem. I think my battery is dying down, so let me quickly rush to get my charger. Meanwhile, quickly read through the screen, please. We've already discussed it, but I want you to spare out a minute and read through it, please. Okay, so done reading? Done? So yes, we've clearly seen that there is a separation of ownership from people who are controlling the organization. And this, with their own personal agendas, leads to a problem which is called agency problem. Now you need to tell me, I've already explained you what the agency problem is, right? But you need to tell me, how do you think, or what are the practical ways in which you can possibly reduce this agency problem, reduce this agency, gap which is there. Obviously, our intention here is to make sure that the objectives of the directors are in line with the objectives of the shareholders of the company, right? So how do you think you can propose to do that? Any practical suggestions that you can give me? How are you going to bring across this closure of gap, this goal congruence between what the shareholders want and what the directors of the company want? So I think the best and the easiest way to do is to make the directors also one of the shareholders. So let's bring on some managerial reward scheme wherein, once you achieve this percentage performance, that is when you receive your bonuses, or we will make you the shareholder. So you give your directors the ESOPs of the company, that is your employee stock option scheme, right? So now they're also the shareholders. So ultimately the director's objective is obviously going to align with what the shareholders also want. And there can also be some sort of discipline brought across by some regulatory requirements, some to-do things, some rules and regulations being imposed on the organization. And that is called the governance, that is corporate governance, wherein organizations are being told, directors are being told certain to-do things and certain do's and don'ts, basically. Coordination among both. Yes. Bonus on the basis of the objectives of the organization. Yes. Good point there, Gograj. As well as rewards. Good, well done, Vani. So what we are doing here is we are trying to bring across goal congruence, either willingly or imposing it by way of corporate governance. So we are aligning what both the organizations or both the entities, both the stakeholders would actually want from the organization. So what is this managerial reward scheme then? Obviously, let's link their bonuses to the performance of the organization. Let's reward them with shares. So let's make them the shareholders itself. So that then becomes again a managerial reward system. And then let's bring across ESOPs, which simply means selected the employees are given the right after a certain date to subscribe for shares in the company at a fixed price is given. So we are hiring, we are giving away ESOPs to the organization, right? ESOPs to your directors, thus making them employees in the organization itself, right? Is this okay with everyone? Does everybody understand ways in which we are trying to bring across this goal congruence of the difference in the objectives between the directors and the employees? In the previous slide, what is the difference between remuneration and empire building? So remuneration is just your pay. Empire building means basically all the perks that come with it. Empire building also includes the prestige. I'm the director of an organization. Does it not give me some empowerment as an individual? Yes. So that is exactly what empire building is all about, right, Gograj? Is that okay, Gograj? Wonderful. So yes, managerial reward schemes are a way of aligning that and bringing across that goal congruence. Also, what we can do is make sure that we are aligning it with some sort of regulation as well. But before that, let's quickly have a look at a few benefits of making the director's pay and payouts linked to that of the organization's, organization's own performance really. So quickly go through the benefits. Done it? So yes, we see that, definitely making your directors payouts, their remuneration, their empire linked to that of the performance of the organization solves and brings across goal congruence in the objectives of the organization per se, as well as that what the shareholders will want from the organization. And then definitely we have ways in which this could be detrimental for the organization as well. Again, what you are basically encouraging is trying to link it to the performance. So they might just try to window dress the performance, or just look at short-term performance of the organization. Why? Because the director ultimately wants a big fat bonus now. So long-term vision, long-term objective of the organization, the mission and the vision of the organization may not be what the directors of the organizations are ultimately working towards basically. So this could encourage dysfunctional behavior, as we call it, because what we're trying to do here is promote that now today we are performing well, so I deserve this big fat bonus that is dependent upon the organization's performance now. However, is it truly working towards the long-term vision of the organization? That I may not be worried about as a director, because clearly my bonus, my performance is now dependent on the company's present performance, isn't it? Quickly read through some of the other drawbacks here as well. It's very generic, so I want you to very quickly read through it. Ask if you have any doubts here. Quickly read through this and ask if you have any drawback, if you have any doubts here in terms of the drawbacks which this managerial reward scheme can kick in. Done? Any doubts? So yes, we are clearly seeing that there is an agency problem, there is an agency gap. We're trying to squeeze in that gap as much as possible by introducing managerial reward schemes. But however, still we see that there are some gaps, there are some drawbacks of doing so as well. So what we need to do is obviously some sort of regulation from the government, from your regulator as an organization, from say SEBI, or SEBI is one body which is going to tell you how to monitor your basically comply to the listing requirements of SEBI, or probably compared to the requirements of RBI. If you are a monetary, if you're a financial intermediary. So then, yes, what we see here is that some sort of regulatory requirements is definitely, required to be enforced on organizations to do the way they are operating things. So corporate governance and listing rules are again way of bringing across regulatory requirements that is going to squeeze in this goal, this goal congruence that we basically want in terms of the agency gap that we have identified, right? So now what is corporate governance is basically it's a way in which organizations are being told how to run and manage their organization. So before I go on to the theory aspect of it, what I want you to do is quickly have a quick look at an introductory video of it. So to better understand what we are heading into. Now, corporate governance is a big topic, so much so big that it is something which you're going to learn in elaborate detail in your next paper, which is going to be your strategic business leader paper. But here at FM level, introduction, what it is, and why it is required, and it basically it is there to be able to fill in that agency gap that we've identified. That much knowledge is going to be sufficient from your FM papers perspective. Quickly have a look at this.
Corporate governance concepts. The basics of corporate governance. Let's take a look at some important questions regarding corporate governance. We will start with, what is corporate governance? There are many definitions aimed at encapsulating the spirit of corporate governance. Corporate governance is simply described as the process by which organizations are directed and controlled in terms of authority, accountability, stewardship, leadership, direction, and control. Corporate governance is more comprehensively described as the framework by which a company's board of directors and senior management establishes and pursues objectives while providing effective separation of ownership and control. It includes the establishment and maintenance of independent validation mechanisms within the organization that ensure the reliability of the system of controls used by the board of directors to monitor compliance with adopted strategies and risk tolerances. Why is corporate governance important? The implementation and maintenance of strong corporate governance policies ensure that proper oversight is in place to hold the organization accountable to the standards, laws, and regulations that it should be abiding by. Effective corporate governance helps an organization to achieve its objectives and desired outcomes and fulfill its obligations through sound strategic and business planning, risk management, financial management and reporting, human resource planning and control, and compliance and accountability systems. Effective governance also helps provide a framework for establishing responsibility to all of the participants connected to the organization spanning clients, employees, and providers of capital. An effective corporate governance framework is essential to a banking organization's overall safety and soundness. How is corporate governance assessed? Assessing corporate governance can be classified into 4 general topic areas: structure effectiveness, board supervision adequacy, management effectiveness, and adequacy of control functions. A 3-tiered rating system of strong, adequate, or weak is commonly used to summarize the results of an assessment. A review of structure effectiveness targets the organizational structure through a top-down review of legal entities, individuals, and policies. More specifically, it focuses on how clearly roles, responsibilities, and lines of authority, as well as communication channels, are reflected in the legal structure of the institution. In addition, it considers the quality of the ethics policy and the code of employee conduct established by the board to guide the actions of management and employees on behalf of the institution. A review of the adequacy of board supervision focuses on elements that demonstrate the ability of board members to understand and oversee the activities of the organization. Board charters are reviewed to understand the legal requirements that are established for the board by the shareholders. The assessment of board committees focuses on how committees are structured, the quality of minutes, and most importantly, the quality, frequency, and timeliness of information flow to the full board. Given the importance, additional attention is placed on the activities of the audit and governance committees. The evaluation of board supervision adequacy also considers board members and their qualifications, the reasonableness of compensation practices, the quality and accuracy of board minutes and reporting, and the adequacy and frequency of training and self-assessments. And finally, a thorough review will focus on board member attendance. Evaluation of management effectiveness centers on management committee charters and activities and line of business metrics. In particular, the review of this area focuses on the qualifications of committee members, the scope of committee activities, and the flow of information to the board. Line of business management, through self-assessments and other reporting systems, can provide useful information to the board of directors regarding risk profile and valuable insight for setting strategy. So, for institutions managed by line of business, which are typically the more complex institutions, the quality of self-assessments was evaluated. As control functions provide an independent assessment of the quality of internal controls and risk levels, their effectiveness and relationship with the board is an important component of corporate governance. In this context, evaluation of the adequacy of control functions focuses on the efficacy of the internal audit, external audit, credit review, and compliance. A three-tiered rating system of strong, adequate, or weak is commonly used to summarize the results of an assessment. A strong rating reflects that for all or a significant majority of the characteristics reviewed for each element, the institution performed at the highest standards possible, and no characteristics were rated weak. An adequate rating reflects an institution generally meeting expectations for each element, but could have anywhere from one to a few instances where individual characteristics did not meet expectations. These shortfalls could be easily addressed in the normal course of business and would not be significant enough to adversely affect any supervisory ratings. A weak rating reflects the institution had one or more characteristics where there were serious shortfalls in meeting minimum expectations. These shortfalls would require significant efforts to correct and could negatively affect an institution's supervisory rating. Now that we have answered some basic questions about corporate governance, let's take a look at the role that banks play in world economies. Chapter 3.
Okay, so that was just a very basic introduction. Like I said, your financial management paper doesn't actually require you to go into much detail of corporate governance, because that is something that you will be studying at the SBL paper level. But having said that, we need to know what basic corporate governance is, why is it required in the first place, what benefits does it bring across to the organization, and what basically are the quick do's and don'ts under the corporate governance regime. So corporate governance is the system by which organizations are directed and controlled. So it basically tells organizations certain do's and don'ts. Corporate governance in itself has two major, you can say, ideology. One is a principles-based regime, which is followed in companies which are UK based, and the others is a rules-based, approach, which is called SOX governance, if you've heard of the name, which is basically followed by companies which are predominantly US based. So principle based is obviously based upon more of following the ideology behind what is the correct way to do things, what is the right way to do things, kind of thing. So key elements which undertake the management as well as the reduction of risk. The overall performance is enhanced by good organizational structures as well as management practices, which are within the set best practice guidelines. It requires the framework for ethical as well as effective behavior to be undertaken by the organization and need to apply the spirit as well as the letter of the law. So here, basically, what we are trying to do is governing organizations, telling them that this is the right way to do things. This is not what you can do. This is what you should be doing. So that is basically another way of closing in on the agency gap that we've identified, because now we are telling the directors clear do's and don'ts basically. So what is it? Quick review. What I want you to do is don't go into too much detail here, because like I said, this is going to be done at your SBL paper level. So, but then yes, you need to have a quick idea in terms of, what corporate governance regimes basically say. So they are very much, introducing the concepts of bringing along non-executive directors on the board of directors. Now, these directors are the people who
What
are
are the responsibilities of
okay. The video itself, I think, says show. So let me first show you the video, then we'll discuss it. And remember, corporate governance stresses a lot about bringing on NEDs, these independent non-executive directors on the board of directors of the organization, to act as watchdogs on the executive directors as to whether the decisions that they are taking are in line with the overall organization's objectives or not. So quickly, let's have a look at this first.
a non-executive director? A non-executive director is a board member without responsibilities for daily management or operations of the company or organization. Non-executive directors are selected and appointed for their personal qualities, experience in similar organizations or industries, and specialist knowledge. Non-executive directors are not employed by the company, but appointed through a letter of appointment. Non-executive directors typically sit on the main board and have responsibility on the board subcommittees, example, audit committee, risk committee, nomination committee, remuneration committee, etc. They challenge, question and monitor the CEO and senior management. They bring an independent perspective to decision making. They hold senior management to account. They also support and mentor the CEO and senior management. They are a critical friend and must act in the interests of the company's stakeholders, such as shareholders, employees, pensioners and suppliers. Strategic expertise, the ability to review the strategy through constructive questioning and suggestion and contributing to the effective decision-making of the board. Knowledge of a director's responsibilities includes an understanding of the role as well as the legal, ethical, fiduciary and financial responsibilities. Accounting and finance, the ability to read and comprehend the company's accounts, financial material presented to the board, financial reporting requirements and some understanding of corporate finance. Legal, the board's responsibility involves overseeing compliance with numerous laws as well as understanding the individual director's legal duties and responsibilities. Risk management, experience in managing areas of major risk management to the organization. Managing people and achieving change, experience in current management thinking on employment, branding, engagement, strategic vision and stakeholder communication. Experience in executive remuneration and compensation. Non-executive directors receive compensation, which tends to be a function of the size of the company, time commitment and complexity of the role.
Okay, some of these videos, I understand the volume is not so great. So what I've done, I've shared the link with you separately as well on your chat box, just in case you are not able to hear it properly, or, the subtitles also don't help. Go back to this video again on your own system at a later time. And that is precisely why I'm sharing the link with you as well. But obviously from my system's end, the volume is already at maximum, right? So what I'll do, we'll quickly have a look at what is it that will be included in the best practices of corporate governance. Now here, our focus is to align the agency gap. Our focus is to tell the managers and directors of the company how things need to be done, how the organization need to run and direct and manage the organization. So this is something which, which we are bringing across the best practices of corporate governance in. So board responsibility for major policy as well as strategic decisions is going to be undertaken. Directors must have mix of skills as well as performance to be assessed regularly. We need to appoint through the nominations committee. Maybe, there has to be division of responsibility, which is happening. Independent non-executive directors are something that we really need to focus upon. Why? Because they are the ones who act as watchdogs on the decisions of the executive directors. Now, corporate governance is very much, is very much focused upon making sure that the organization's operations are being managed and controlled by way of various committees. Committees include the nominations committee, the remuneration committee, the audit, as well as the risk committee. In all of these committees, we are bringing across on the committee board the non-executive directors to make sure that the decisions are being made in the correct light, in the correct, you can say, in the correct spirit of the organization, in terms of what the organization should expect from the organization's overall behavior. So now this is what the overall corporate governance regime is. Believe you me, you really don't need to go anything beyond this here. Apart from corporate governance, listing requirements. So if you're an organization which is listed on the stock exchange in India, you need to comply to the regulations of SEBI. Similarly, in the UK, if you're listed on the stock exchange, you need to comply to the listing rules of the London Stock Exchange. And this compliance, even though it's not like obligatory, it is something that has to be complied to as best practice of the corporate governance regime. Right? So this was just to basically cover what we still have to do from our books. Now you should be able to answer this question, everyone. So quickly go through this question, and there's an activity 3 also which is left. So I'll go back to that question as well. So quickly answer. Now you should be able to answer because I've covered like all the topic, of this basic question now. So this entire chapter is over from my end. Quickly read through it and give me the correct answer, please. Quickly pour in your correct answer, please. We've already done it. So which of the following statements is true? Wonderful, Vinaya and Sahitya, that yes, the agency problem means that the shareholder wealth is not being maximized. And that is what is leading to the whole agency problem, right? Okay with everyone? What about the others who have not responded? I hope this is okay with everyone. Quickly have a look at activity 6 then. Quickly pour in your answer. Quickly, guys, pour in your answer. I want everyone to answer, please. So which of the following aspects of the investment in country A would you expect to be the responsibility of the financial management? So definitely it's a foreign investment. So as a finance manager, you are going to be required to look at the exchange rate risks that the new operation is going to bring across to you as an organization, isn't it? So managing, you cannot bring in, just for profits really. What you will be required to do as one of your key KRAs would be to manage the exchange rate risk which the new operation is going to face, right? Forecasting is just basically preparing accounts, preparing, a forecast. That was not something that going to be, what you're required to do. But what you will be required to do is to continuously manage the exchange rate risk, right? Is that okay with everyone? Little confusing there, but yes, that would be one of the major aspects that you would be required to do. Producing regular profits is not going to be your role. You're only a finance manager, right? You're not the sales director of the company. You're not the production director of the company who has to make sure that profits are coming in. Reporting is something that could probably be like your KRA, but managing the exchange rate risk is certainly your primary KRA here, right? Remember the question. What is the question asking you to do? Your role, your key responsibility as a finance manager here, not as a not as a director. Had you been put in the place of a director, then probably one of your key KRAs would be to make sure that regular profits are coming in from this business. But now as a finance manager, what your role is to make sure that whatever foreign exchange fluctuations you're facing because of this foreign investment that you've done, that is kept under the belt. Right, Vinaya? Is that okay with everyone? Remember to read the question very, very carefully. What is it that you're being asked to do in what position? So as a finance manager, can you ensure profits? Can you do that? No, right? Recording the acquisition of new non-current assets in Mount Company's financial statements. That is something which is definitely going to be there, but that is not going to be your primary responsibility. That is something that is just bookkeeping, right? So that is not a responsibility per se. That is just a bookkeeping job really. But yes, what role you're required to do as a responsibility of under financial management gamut would be to manage the exchange rate risk, right? So remember, your key important roles that you do as a finance manager is your acquisition decisions, where the money is coming from, your dividend decisions, how much dividends be given back, your investment decision, your exchange rate management is one of your key KRAs and which is one of your key responsibilities as a finance manager, right? Is that okay, Vani? So yes, bookkeeping is there, but it is majorly a role of an accountant, not even like a finance manager here, right? It is beyond just bookkeeping role that you are undertaking here, right, Vani? So recording of acquisition is there, but majorly the role of a accountant. You're now a finance manager, which is a bigger responsibility per se, right? Wonderful. I think there's one question that we are still left to do in this workbook. Activity 3, I think we did not do because at that time we had not done that topic. So I'm just going back to it. Just want to make sure that, all questions of the workbook are done in the class itself so that you have done practice with me here in the class on all aspects. And then we will hop on to our practice and revision kit. Okay, corporate governance, quick question there. Quickly have a look at activity 3 and pour in your answers, please. Okay, answers pouring in, so I can have a look. C option, which means one only. So let's have a look at it. So the following statements have been made about corporate governance. Sound system of corporate governance involves the establishment of risk management and internal control procedures for the organization. Yes, definitely yes. Good corporate governance requires the organization to always act in an ethically acceptable manner, even if that is contrary to the law. No, you cannot go beyond law, right? It always has to be in tandem with what is per se allowed under your legal jurisdiction or not. A non-executive director should not be paid for his services to the organization in order to keep him independent. No, nobody's going to work for free, right? So yes, even the non-executive directors need to be paid a remuneration, but to keep them motivated to act as a watchdog on the executive director. So certainly only statement number 1 is correct. So option C is what we will select. Is that okay with everyone? Okay with everyone? So we have done our chapter. We've done all activity from your workbook. Let's quickly open up your practice and revision kits now. Guys, we've done chapter 1 from your workbook. We've done all the questions on it as well. Any doubts? Any doubts? Anything anybody would like to ask here? Okay, let me stop sharing the screen and open up my practice and revision kit, please. I want everybody to also open up your practice and revision kits. I hope you got in touch with the team at VGLD for your books. Very, very important, because without the books, you will not be able to do question practice. And without question practice, obviously nothing is going to work out, right? Okay, so let me just start sharing the screen again. What I'm going to do is, I'm just opening up my book. Okay, let me show you the front of the book as well. So there are 2 books which you need to buy as a combo. One is a workbook which basically explains all the concepts. So all the concepts which I am preparing in the form of PPT notes for you are coming in from your workbooks. And it has some additional question practice as well. So we are covering all the questions from your workbook, and this is the approved practice and revision kit, which is going to be applicable for your attempt, which is obviously June 2023, right? So this is our recent workbook, which we need to do. Now, this has very beautifully broken down questions chapter wise, which, is going to help us do simultaneous question practice. So like we have just covered part A of the syllabus. So we now know that we can literally do all the questions from question number 1 to 20. And like I said, your part A of the syllabus is going to be generically and, majorly asked in section A and section B questions only. We don't, honestly expect like a section C question coming in from there. But yes, section A and section B are easy marks, are, marks that we really don't want to miss out on, because these are good, easy peasy 2 marks each. Okay, what I'm going to do is open up the question for you. Okay, let me give you a quick 10 minutes break. Quick 10 minutes break for everyone, and then we will start with question practice. Since there are not many questions here, 20 questions only, and this is the first time which, I'm showing you the book and we are going through the book. So we will be doing all the first 20 questions together to be able to, just get rid of our chapter 1 really in thorough practice. When we have like more questions, and it would, get practically difficult for us to do everything in the class itself. That is when I will be referring to some questions to be done as part of homework. We will obviously be picking up few questions randomly here as well to be done together. But let's start with section A, chapter number 1, question practice after 10 minutes from now. Okay, apologies. I think you got a longer break than I intended to give. There was a minor electricity fluctuation at my place. So the Wi-Fi goes and then, it takes like 5 minutes to reconnect back. Okay, so nonetheless, let's quickly open up our practice and revision kits now. Again, some formulas which will be given to you are there listed. And then it also has a list of formulas that you need to learn. Please, there will be some formulas given, but there will not be all formulas given to you in your exam. So please check out this list. These are the list of formulas that you need to learn, that you should be familiar with, that you should be able to apply on your own. So all of these are listed here as well in your practice and revision kits. And then we will start with practice. Okay, so let's open up. There we are. So we have done the first chapter, which talks about the financial management function. And we've got question number 1 to 20 from our practice and revision kits that we can actually practice on the same concepts that we've just studied for. So very quickly, I want you to do these questions. I am just here to check and tell you whether your answer is correct or not, but you are the one who's supposed to be doing this question practice. So very quickly, please open up your Excel and start solving and pour in your answers, please. Now remember, read the questions very, very carefully. If the question is asking you to insert your answer to 2 decimal places, please give me your answer to 2 decimal places only, right? So quickly, guys, start pouring in your answers. Okay, answers pouring in. 0.80. Remember to pour in your answers to 2 decimal places, please. That is what the question is asking. So let's quickly start. Last year, ABC company made profits before tax of 2,628,000. So that's 2.6 million 28,000. Amount tax amounted to 788,000. ABC's company's share capital was 2 million, that is 200,000 shares of $1 each. 2 million shares of $1 each, and 4 million 6% preference shares. So you have to calculate the earning per share for the year. So very quickly, let me open up my Excel. I have got answers, and I want everyone else also who has not answered to please do this yourself. Open up your Excel, try to solve it. You should be able to do this. Even if you're not able to do this, that's fine. Don't worry. We are here to do question practice. And when you do question practice, slowly and gradually, you will be there. But please just start doing it from now itself, right? So what do we have? Profit before tax. I'm just opening the book for myself as well so that I can take the figures from here. 2628,000, 2628,000. Yeah. So you obviously need to reduce tax from this, which is equals to 788,000. So profit after tax comes out to be this minus this. And then you have to give away preference dividend. Also remember, you have to calculate the profit which is attributable to equity shareholders. So this is what? 4 million you have. 1, 2, 3, 4, 5, 6 zeros into 6% is the interest that needs to be paid. So but what is the earnings which are attributable to equity shareholders? Let me just wrap it up. Is equals to this minus your preference dividend. Number of equity shares. How many equity shares do you have? 2 million. Okay, so 1, 2, 3, 4, 5, 6 zeros for a million. And then that obviously makes it earning per share equals to my profits attributable to equity shareholders divided by the number of equity shares. And that's equal to 0.8. I have to pour in my answer to 1 decimal place, 2 decimal places. So that's equals to 0.80. Wonderful, guys. Thank you so much for answering. And it's just great that you're all able to calculate this. Wonderful. For others who've not responded, I hope it's clear now. Please Please, please, please stop me. Ask me if you have any doubts here. If you will not respond, you will not give me the answer also, you will not ask your doubt also. How will I be able to know that whether this is clear with you or you still have a doubt? Please don't keep yourself, hanging in midair. The purpose of the class is that you ask your doubts to me. So please don't feel shy. Don't be wary about, what other students will feel. No, you've paid for the classes. You have to utilize the money that you've paid for the classes, right? So please go ahead, ask your doubts. I'm more than happy to repeat and, explain any concept again and again till the time I get 100% clarity from everyone that you're all good to go ahead. Okay, answers coming in for the next question. So very quickly, others also keep responding. Which of the following statement describes the main objective of financial management? So remember where the money is coming from, where the money is getting deployed to achieve what you want to achieve. So clearly statement number 1 is the primary objective of why we need to do, financial management, where the money is going to come from and where it is going to be deployed to earn maximum returns, right? So statement number A. Some of you mentioned statement number D. That is what the primary objective of the organization is. That is not what the main objective of the financial management is. That is what the organization ultimately wants, right? Financial management, where the fund is going to come from, how am I going to deploy this to be able to achieve the objective, which is, the objective is maximization of shareholder wealth, right? Is that okay with everyone? For those who mentioned D, is this okay now? Wonderful. Question number 3, very, very quickly, guys. Pour in your answer. Okay, quick question here. Company has recently declared a dividend of 12 cents per share. The share price is 3.72. Come dividend. Remember, always we have to calculate our PE ratio based on the share price X dividend. So remove the latest dividend, which was an earnings for the most recent year were 60 cents per share. So remove this recent dividend of 12 cents, which has been paid, which is 12 cents given here. So 3.72 minus 12 cents is going to be my share price X dividend divided by my recent share price. So let's quickly calculate my price earning ratio. Okay. So PE ratio, take your share price X dividend always and divide that by your earning per share. So what is my share price X dividend? 3.72 minus the 12 cents of dividend which was recently given away divided by my EPS, which is what, 60 cents it is, right? So that makes it equals to 6 times is my PE ratio. Wonderful, guys. Well done, guys, who got that right. What about others who've not answered? Any doubts? Anything anybody would like to ask here? Guys, I am again and again, reiterating the same thing, that either you answer so that I know that you've got that right, or ask doubts, or give me a thumbs up that that we are good to go ahead. Okay, question number 4 for you then. Very quickly, everyone. Now, this question is certainly going to take you a little time because you will have to calculate and see which of the following statements is actually correct. So I'm giving you a little time to be able to calculate this and check which one of the statements is actually correct. Very quickly. Okay, apologies, guys. It's just that once the light goes and then it comes back again after 10 minutes. So again, the same thing happens after 10 minutes. Really apologize for that. But let's quickly have a look at this question now. So the dividend payout ratio is greater than 40% in every year in the period. So what you really have to do is just calculate the dividend payout ratio in every year. And is it actually greater than 40% in every period which has been given to you? So do that very quickly and check if that is true or not. Is it true? Is it true? Is it not true? Mean growth in dividends, which means from one period to the other. So calculate mean growth of dividend. So it has increased to 15 from 13 over a period of 3 years. So calculate mean growth. Total shareholder return in the third year is 26%. I really cannot calculate total shareholder return because I don't even have the share price as at the end of the third year, right? So third point, I really cannot even calculate. Mean growth in earnings per share of the period is 6% per year. Let's check which one of the following statements is true. Meanwhile, I await your answers, guys. Quickly pour in your answers. Yes, this is going to be a time-taking 2 marker because we literally have to do a lot of calculations to be able to check which one of it is actually true or not. So mean growth in earning per share. So it's increased to 15 from, EPS, right? Let me just have a look. So it's increased to 35.7 from 30. Okay. So we need to obviously calculate the third root of, so either you just take it like this or I can just take it like 35.7 divided by the base, which was 30, raised to the power. Third root I need to calculate, so I can just do 1 divided by 3 here, or just from your calculators take the third root directly. So do it as per what you are able to, and then this obviously -1 because you have to calculate the growth rate. So this -1, so that actually makes it equals to, let me just open up the decimals. Which is equals to, sorry, this is equals to this -1. Okay, I need to remove the percentage here. This -1, which, why is it coming in percentage form? So let me just show it to you here. This -1 is what we need to calculate in terms of my growth rate. And this I can just do in a percentage form. So that is 6%. Is it? What does the statements show? The mean growth in dividends per share over the period is 4%. No, it is actually 6%. So it's obviously wrong. Third statement, I cannot even calculate. What else is there? Mean growth in dividend. Okay, let's calculate dividend as well. From it's increased to 15 from 13. Okay, mean growth in dividends. Again, just do the same thing. I hope everybody's familiar with how to calculate mean growth. raised to the power. Because I cannot do a third root here. So I'm just doing raised to the power 1/3 here. And then obviously this -1, and in terms of percentage, what does the statement say? Mean growth in dividend per share over the period is 6% per share. So is that correct? Mean growth in earnings per share is 6%. Okay, sorry. This is what we had calculated in earnings per share. So it is 6%. Yes. So statement number 4 is correct. Is everybody okay with it? So this is actually statement number 4. Statement 4. So which is correct. Does everybody agree upon this? Guys, have you been able to calculate this? I need your answers. I need your doubts. So TSR of the third year, you cannot actually calculate. Cannot calculate because you really don't even have the share price at the end. Remember, what is given to you is at the beginning of the third year, end of the third year. So you really can't even calculate this. And your dividend per share, dividend payout, just calculate it for every year. Is it giving you, what does the question say? 40%, I think it is. Greater than 40% in every year or not. So just calculate the payouts, please. Right? Is that okay with everyone? Any doubts here, guys? Please ask. Are we good to go ahead? I need everybody's reply. I will not know whether the question is okay with everyone or not. Such type of questions take time. Obviously, you have to run out on your time, which is 1.8 minutes per mark. So in 3.6 minutes, you really cannot calculate all the 4 calculations. But there will be other questions which will compensate your time which you have spent here. So overall, as long as you're not overspending on time in your section A, that's perfectly fine. Right? Quickly have a look at question number 5 then. Pour in your answer. Keep them coming. I want everybody to answer. Okay, so which of the following is least likely to fall within financial management? Dividend payment of shareholders is increased. Obviously, that's a role of a financial manager. Funds are raised to finance an investment project. Again, the role of a finance manager. Surplus assets are sold off. Yes, definitely very much a role of a finance manager. NEDs are appointed to the remuneration committee. Nothing really that a finance manager is doing. So this is certainly least likely. Option number B. Wonderful, guys. Okay, let's quickly proceed with the next question then. Question number 6 is what I want everyone to answer. Okay, so let's see. PT company has just paid a dividend of 15 cents per share and its share price 1 year ago was $3 per share. The total shareholder return for the year was 25%. What is the current share price is what you need to tell me. So you have basically all the details on you. All you really need to do is find out the current share price. So let's put down the details in the total shareholder return formula, which is P1 minus P0 plus your dividend. All this, let me just put that in a bracket, divided by your price at the beginning of the period. So total shareholder return is what? 0.25 given. My current share price is what we are looking for. Minus P0 is what? P0 is 3 plus the dividend paid is 0.15. All of this divided by my base price, which was 3. So quickly calculate this. Multiplied by 3. And then what does this come out to be? Equals to P1. P1 minus 3 plus 0.15 will be equals to minus 0.15. And then we can just take it. P1 minus 3 plus 0. Okay. So let me just P1 minus 3 plus 0.15 and then just solve this for me, please. So what is your P1 coming out to be? 0.75 plus 3 minus 0.15. Remember, when you take it to the other side, your signs are going to change. So 3.6 is the value of your P1. Does everybody agree upon this? Oh, wow. I see so many correct answers. That's just great, everyone. Wonderfully done. What about others? I hope everybody's got that right. It's a simple putting in the formula details. So question number 7 then. Go ahead. Pour in your answers. Okay, so which of the following does not form part of the objective of corporate governance? Best practice framework, separation of the role of CEO and chairman, very important point of corporate governance. So definitely there. Establishment of committees, definitely there. Minimization of risk, not so much so, because that is something which will eventually happen when you manage the risk, when you manage the organization properly, but that is not one of the objectives of corporate governance. Employment of NEDs, definitely yes. So least likely, I will definitely include option number C here. Wonderfully done, everyone. Well done, guys. I'm happy that you're all able to solve these questions. And believe you me, these are actually financial management past year questions that you are solving. So if you're able to do these questions, you're actually securing marks as you go along. So that's just great, everyone. Quickly pour in your answers for question number 8 now. Okay, answers pouring in. I want everyone else to also respond and then we will review it together. Okay, more answers coming in. So let's review then. Remember, when I'd actually shown you an actual FM exam, it did have questions like this as well, wherein you were supposed to mark an option for every statement which was given to you. So very much exam standard questions here. Maximizing share, market share is an example of a financial objective. Is that a financial objective? That's definitely not a financial objective, right? So I would choose a false here. Shareholder wealth maximization is the primary financial objective. Yes, absolutely. Yes, it is for a company listed on the stock exchange. So that's a true. Financial objectives should be quantitative so that their achievement can obviously be measured as well. Yes, that is true as well. So I will also go in for a false and a true. I think most of you have got that right. Let me just check if anybody got that wrong. Mitul, is that okay now? It's a false and a true. Sahitya, false and a true. What about you, Sahitya? Is that okay now? Wonderful. So let's quickly move on to the next question then. Remember your value for money, the 3 E's to measure the performance of a not-for-profit organization: economy, efficiency, effectiveness. So quickly pour in your answers for question number 9. Remember, what is efficiency? Maximum output using the minimum input. Okay, so yes, when we are looking at efficiency as a parameter, what we have to look at the best fit is certainly cost per journey to the hospital. How do we reduce the overall cost per journey to the hospital, making it more efficient from the organization's perspective, right? I hope everybody got that right. Percentage of members who reuse the service. So reusing of service is not going to be efficiency from the hospital's perspective, right? That is something which is basically optimizing, or you can say it is basically an effectiveness, a parameter and not an efficiency parameter, right? Efficiency will always be in dealing with highest output with minimum cost. Okay, everyone, those who selected A. That is not efficiency. Wonderful. Quickly have a look at question number 10 then. Try to do this yourself and then we shall do this together. Okay, answers coming in. So that's wonderful. H company's share price is 3.5 at the end of 2011 and includes a capital gain of 0.75 since the beginning of the period. So you can calculate the share price at the beginning of the period as well. A dividend of 0.25 has just been paid. So that's, in fact, everything that we really need given to us. So what do I do here? Let's just quickly calculate my total shareholder return. So my P1 is what, 3.5? 3.50. My P0 is 3.5 minus the capital gain, which is 0.75. Dividend given away is what? Let me just read to the question. 0.25, is it? Yeah, 0.25. And I have my total shareholder return. Again, the same formula. We are just literally doing the same thing, equals to plus my dividend divide by, which is equals to, let me just put it in a percentage form, 36%. 36.4. Okay, is it asking still one decimal place? 36.4. That's just great, guys. Wonderfully done. Any doubts? I hope everybody's got that right. Guys, for those who are not answering, I'm again and again requesting you to please either put in your answer in the chat box or ask a query if you're not able to solve it. Because if you don't ask, I will not get to know whether you've been able to do this or not. Question number 11 then, very quickly. Okay, so what do we have here? Accounting profit is not the same as economic profit. Absolutely true. Profit takes account of risk. Does it take account of risk? No, it really does not. So that's false. Accounting profit can be manipulated by managers big time. Yes, that is always, one of the major concerns what we face, that why, these huge corporate scandals come up. So it's a true, false, and true. Wow, wonderfully identified by everyone. Great going, guys. Question number 12 then, very quickly. Pour in your answer. Okay, so let's have a look at the question. A government body uses measures based upon the 3 E's to measure value for money generated by a publicly funded hospital. So which of the following relates to efficiency? Obviously, cost per successfully treated. Patient is going to tell you how efficient the hospital is in being able to treat the patient as well as keep the cost to a bare minimum. Cost per operation, but remember here you have to keep into account not just the output but also the input. So cost per successfully treated patient is going to tell you how efficient the hospital is, right? I can keep the cost very, very low, but the people are dying whom I'm operating. Does that show that the hospital is efficient? See, these are the distractors that the question is going to give you. So please don't get distracted. You have to always use your common sense also. The hospital, how efficient it is going to be told by keeping the cost as low as possible, yet at the same time making sure that the patient is getting successfully treated, isn't it? Guys, I think everybody fell for this trap this time. Is this okay now? Is this okay? Why it is a A and not a B? So don't fall for the distractors. Read every question, every option very, very carefully. Wonderful. What about others? Question number 13 then, very quickly. So tell me which of the following statements is not correct. I think this is just basically quick revision of your formulas. Quickly read the question carefully, please. Again, I'm saying instead of jumping your guns, read the question very, very carefully. Is it not correct? So here we are checking on which of the following statements is not correct. So what is your return on equity? Profit before interest and tax or profit after interest and tax divided by shareholder return? So is it not D? Yes. So please, again, do not fall for these, small traps that the examiner is setting up for you. Read the question very, very carefully. Read each and every word very, very carefully. Right? Question number 14 then, very quickly. Okay, answers pouring in. So I think we can start. Ghee company paid an interim dividend of 0.6 cents per ordinary share on the 31st of October and declared a final dividend of 0.8 on 31st of December. Obviously, so the total dividend paid during the year is going to be 0.06 plus 0.08. So always remember to add your any interim dividends that have been paid during the year as well. The ordinary shares in Ghee Company are trading at a cum dividend price of 1.8. Remember, always we have to take it at an ex dividend price. So remove the amount of dividends which have been paid, that is 0.06 plus 0.08. You need to calculate the dividend yield. So let's just calculate dividend yield. Simple. So dividend paid. So that's going to be obviously a summation of both types of dividend which have been paid and dividend. So what is my share price? Share price X dividend. So that obviously equals to how much? My share price X dividend. What is my cum dividend share price? 1.83. Okay, I'm just taking it from your books, guys. Please, everybody, you also take it. Now, what is the amount of money that has been paid out of this? Obviously, that is going to exclude your final dividend of 0.08 that has been paid, right? So that comes out to be how much? 1.75. But dividend, the topper which you're going to take is obviously representing both the interim as well as the final dividend. Your share price, however, has already reflected the interim dividend which was paid during the year. So now you only need to remove the final dividend which was paid off. So my dividend yield is how much? 1.75, 0.14 divided by my total X dividend share price, and just to earn a percentage of it, which comes out to be equals to, let me just put that in a percentage form, 0.08%. 8%? Oh, okay. So my share price here is 0.14. Yeah, so that's right, guys. So 0.14 divided by 1.75. So that is in fact 8%. Sorry, I just did it double my percentages, right? Is that okay with everyone? 8%. I think most of you have got it right. But the tricky part here was to make sure that add interim dividend here and remove only final dividend here. Right? So please don't get confused in this. It's wonderful that you've all got that right. Question number 15, very, very quickly, please. Sure, Vinaya, let me go back to the question that why only final dividend is removed, because in the share price. So when in October, we released our interim dividend, the share price would have obviously captured the impact of that share price and thus reflecting the interim dividends, payout in the share price itself. After that, however, the final dividend has just been paid as well. So that is something which is not being captured, because in the share price, it clearly says that it is the share price cum dividend. So when that is the case, in the cum dividend situation, you remove the final dividend to come at the share price X dividend price. right? Because interim happened in the middle of the year, that is something that has already been absorbed by the share price. Right, Vinaya? Wonderful. Quickly pour in your answers for question number 15 then, everyone. Quickly pour in your answers for question number 15, guys. So let's have a look at this question. Increasing which two of the following would be associated with the financial objective of shareholder wealth maximization? So if share price is increasing, definitely your wealth as a shareholder is increasing. If dividend payment is increasing, definitely your wealth as a shareholder is increasing. If reported profits are increasing, but then what happens if we do not, if reported profits are there, but they are not actual profits, or they are not getting distributed to your ultimate shareholders, then obviously, that doesn't actually increase your shareholder wealth maximization directly. So that is not earning per share. Again, this is not a direct, that is not directly associated. So two payouts, if I have to look at, then definitely share price and dividend payments would be the one that definitely directly increase the shareholders' wealth maximization, right? So A and C, A and B. B and D is what most of you seems to have selected. D, earning per share is there, but it is not direct. But if the share price is increasing, is it not directly leading to an increase in the shareholder wealth? So earning per share is there, but not like, it is not directly impacting, right? That will only happen once you're actually going out there and looking at your payouts over the years. So for two direct reasons, two directly associated reasons, I would choose share price and dividend payment for sure. Is that okay, guys? Little tricky there, but then you have to look at that, what are the two factors that are going to directly increase the shareholders' wealth, right? Yes, that's true. So your earning per share is actually dependent upon the amount of share price and the dividends that are being paid out. So I would choose A and B. Is that okay with everyone? A and B option, is that okay with everyone? Any doubts, guys? Anything anybody would like to ask? Because then we are opening up a section B question, which is very much based upon chapter 1 that we have just done. Remember, chapter 1, definitely you're going to expect section A and maybe a section B question as well. Section A, 100% is going to be there. Section B, maybe a question can come. And so let's practice a section B question as well that can be asked on this topic. Remember your section B questions. One scenario on the left followed by 5 2-marker questions on the right. So this is exactly what the question is. What I'm going to do is, I really don't know whether you've got your books now or not. Do you have your books on you? Or not so, not at the moment. Guys, do you have your physical books with you or not? Let me share the details in case you don't have it. Please buy it before the next class, guys. It will become difficult for us to be able to, do question practice otherwise. Okay, so there you are. The question is on your screen. The question is a little long, so I will just obviously have to keep going up and down for you. So one scenario followed by 5 2-marker questions based on the same scenario. So 16, 17, 18, 19 and 20, all 5 are related to the same scenario which is given to us. A section B question is what we are practicing. So there you are. Let me know when you want me to go up and down. So the first thing you have to do is, what is the percentage increase in return on capital employed for ABC company between 2007 and 8? So return on capital employed is what you have to calculate, and the percentage increase in the 2 years. There you are. I'm just showing you the relevant details that you would require. Quickly calculate. We'll do them one by one. Quickly, guys, pour in your answer. We'll do one question at a time. So you have to tell me the percentage increase in return on capital employed. So calculate return on capital employed for both the years given, and then we'll calculate the percentage increase. Remember your formula, return on capital employed is your PBIT divided by your long-term capital, which obviously will include both your shareholders funds given here as well as your long-term debt. So this figure given here is what you have to use. This is going to be the denominator, and the numerator is obviously your profit before interest and tax. So this shouldn't really take so long. Okay, so let's see, what do we have here? I am just going to calculate my return on capital employed for the 2 years, which is 2008, and then the previous year, which was 2007. So what do we have here? Profit before interest and tax. 14. I'm just taking it from your books, guys. 14,749 divided by my total shareholder. Remember your long-term capital, which will include your long-term debt as well. So that's 53,900. And then previous year, similarly do it for previous year, 13,506 divided by my total fund, 52,587. This will include your long-term capital as well. So now you have the figures. Can you calculate the percentage increase? So obviously percentage increase will be current year minus last year divided by my last year. Will always be the base price whenever you're looking at a percentage increase. And if it's required in percentage, so let's quickly do it in the form of a percentage. So that's 6.5% is what the answer is. Wonderful, guys. I have got the correct answer from Vani, Saitya, Mitul and Palak. What about others? Guys, is this okay with everyone? Any doubts in this question? Do you want me to explain anything? Is everybody able to calculate this percentage increase of 6.5%? Quickly tell me. I am asking because I need to know if everybody is okay with it. Guys, others who have not answered, is this okay with everyone? Meanwhile, the others can start working on the next question, which is what is the operating profit margin for 2008? So quickly calculate the operating profit margin. Let me show you the requisite figures that would be required. So quickly do this. Okay, so do we have the figures? Operating profit margin for 2008. Let's calculate our operating profit margin, which is going to be my PBIT divided by my sales. So 2000, oops, I put is equals to here. Okay, so which is obviously equals to, what is my PBIT here? 14749. I'm just taking the figures from your books, guys. Please refer to the question. Divide by sales. 74521. 74521, it is right, which is equals to 19.8%. Great going, guys. Wonderful. Let's hop on to the next question then. I hope it's clear with everyone. Total shareholder return. I'm sure you all are pros at it by now. So quickly calculate total shareholder return. Let me show you the requisite figures to be able to calculate total shareholder return. Okay, so quickly calculate. You already have the share price at the beginning, at the end given to you. So from 7.41, it has increased to 8.82. Do you have the latest dividend given to you? Dividend per share of 0.34 has been paid. You literally have all the information laid out beautifully for you to be able to calculate your total shareholder return, which is equals to, I'm just taking the question, the figures from your book. 8.82 minus 7.41. 8.82 minus 7.41 plus the dividend of 0.34, which is paid. Divide this by my base price, which was 7.41, which makes it equals to, let me just put that in a percentage form. 23.6% is what the answer is. And that's wonderfully calculated by Vani, Vinaya, Sahitya, Sneha, Palak, Seher, and Mitul. Wow, guys, wonderful. I'm happy to see that you're all able to calculate these basic questions. So these are easy 2 marks in your kitty, guys. So quickly have a look at question number 19 now. Okay, so let's have a look at this as well as the information above. The extra information is given to you. So based on the information available, are the following statements true or false? True or false, sorry. Employees may be unhappy with their wages in 2008. Let's see what's happening with the wages of employees. So if I look at it, wages have very, very marginally increased, even though there is a good increase in the amount of profits that the company is making, isn't it? So yes, I would agree with the statement that the employees would, not be very happy with their wages in 2008. Financial risk for shareholders appears to be a problem area. Financial risk for shareholders, the gearing has decreased. So the financial risk has definitely decreased. So that is not a true statement. So I will definitely go in for option number 1. So that, what do we have here? We have the fact that statement number 1 is true and 2 is false. Is that okay with everyone? How do we present these answers in the exam? Were you not there yesterday, Manpreet? Did you attend yesterday's session, Manpreet? Tell me. So questions like this would be a drop down, which you have to just select the correct option of. Manpreet, were you there in the session yesterday? So I showed you like the kind of questions and the response options which will be given, right? So section B will not have any constructed response option given to you. You only have to make use of your rough paper or your scratch pads to do calculations and then just select the correct option, right? Inflation is same, so employees may be unhappy. Yeah, so definitely employees are going to be unhappy because their wages are, may not be unhappy. No, but then look at the amount of profits that the company has increased. Has the wages of the employees increased in the same proportion? Not really, right? So employees are going to be little unhappy. Inflation has got nothing to do, which is in the hands of employees. Inflation is rising, they have to accept it. Inflation is not rising, they have to accept it. But their payout from the company's side is something that, they would want to put a pressure on the management and try to get it increased. Isn't it, Mithul? And especially when the company is doing well, the employees will want to have a bigger share of the pie, really, isn't it? Right? Is that okay, Mithul? Tell me. Yes, if you look from purchasing power side, so obviously somebody who was earning, say, $1,000 previously is now earning $1,005. Really doesn't make a big difference, isn't it? Because it has very marginally increased the payout of wages. So that's it then. Quickly have a look at question number 20. Pour in your answers, please. Okay, quickly pour in your answer. Accounting profits may not be the best measure of a company's performance. Which of the following statements support this theory? Profits are affected by accounting policies. Definitely, yes. Profits take no account of risk. That's true as well. Profits take no account of the level of investment made during the year. That's true as well. and profits are a measure of short-term historic performance. That is true as well. So I will definitely go in for that. All the statements are true, which is option number B. Well done, guys. I think you all have done wonderfully well. I've done, in fact, all the questions which are there from your this chapter 1 of your syllabus, which is part A of your syllabus. So you all should be like on your, on your toes for this now. You all should be, thinking that, okay, you're like pretty geared for the exam from part A of the syllabus perspective, because we've literally done each and every question, and kudos to you that, you've literally solved almost all the questions perfectly well as well. So that's just great going, guys. And any doubts? We are done with part A of our syllabus. Anyone has any doubt, please feel free to ask. Any doubt? You can always reach out to me on the WhatsApp as well. I think that's a quicker way to, get in touch with me rather than emailing me. I'm a little poor at checking my personal emails. But please, all, if you have any doubts in your revision sessions, anything that, you want to reach out to me, I'm always available on WhatsApp. So please reach out. Any doubts? And before I actually proceed to the next chapter, which is going to be part B of the syllabus now, I want to take a quick, feedback from you all. How are you, liking the classes? Anything that you want me to change in the way I'm teaching? Anything you're liking in the classes? Good, bad, ugly? Please share your feedbacks very, very quickly, because then that will give me a heads up in terms of, how do we proceed with the rest of the lectures? Quick heads up, guys. I am waiting for everybody to respond in the chat box. If you want to send a personal message, that's also fine. I am just quickly waiting a quick reply from everyone so that we know how do we proceed with the rest of the lectures. Any areas you want me to, probably change the way I'm doing things. I'm happy for all kinds of suggestions. Notes will be shared, Saite. So I shared yesterday's PPT notes up till this lecture with Sandeep yesterday itself. Obviously, it's Sunday today, so it's a day off for the team. You will be getting the drive on your WhatsApp link and on the LMS. Because this lecture will, get rendered, edited, and then be uploaded on the LMS. So that will take, say, by Wednesday, it should be uploaded. But on the, just from the notes perspective, you will get it. I'm not 100% confident in my ratios. Just practice. Vani, that's the only thing that you really need to do. More and more question practice is all that is required. Right? Do question practice, revise your basic class 12th notes for your ratio analysis. If still you feel you have little, doubts about it, go through that, that link that I had shared yesterday. Are you ready to take on your FM paper? Please just go through that link first. PPT has been shared yesterday. Yes, so that is all that is there, right? Yes, I've shared the PPT, so you should be getting it. Wonderful. Any other feedback, guys? Because what we will do now is we will quickly break for lunch and then start with the next chapter post lunch. So quick lunch break. Um, 2:30. I think that should be a good time for everyone to join back, and then we shall continue. Okay, then. Thank you so much, guys. See you on the other side of the break. Okay, I hope everybody is back post lunch. Do we have everyone? So let's start with part B of our syllabus now, wherein we will be talking about the economic environment in which businesses operate. So we are here going to be talking about the macroeconomics part of the operations that impact businesses, the government decisions, the policies that the government make, and how these decisions impact you as a finance manager, how you have to consider that, what is the monetary policy talking about, what is the fiscal policy of the government, and how these these policies impact your business so that you can manage your business better. So the economic environment for business is what we're going to study in this chapter. So like I said, economic policy is where we are looking at. Now, first, you need to tell me what are the macroeconomic policy objectives that the government will have. Any idea? Basic level, economics, everybody's done. What is it that the government, endeavors to achieve via these policies? Any idea? So the government wants what? The government wants good employment for everyone. The government wants a steady growth of the economy as such, so economic growth. The government wants an acceptable distribution of wealth amongst its people. So we don't want to just make the rich people more richer and let the poor people suffer. So there has to be a good amount of price stability being thrown in so that our levels of inflation can be stabilized. We also want a good solid balance of payment, which simply means that we are exporting more than what we are importing, which means our input, our foreign currency that we are getting into our economy is more than what we need to pay to the rest of the world. So these are definitely some of the macroeconomic objectives of the government. Now, how does the government achieve these macroeconomic objectives? Obviously, by way of setting up its policies. Any idea? Any idea what policies the government fixes in order to, achieve these objectives that we've just done? Any idea? So yes, we're going to have a look at the monetary policy, the fiscal policy, the exchange rate policy, as well as the external trade policy, which all four policies are set by the government as part of its macroeconomic policies, which impact the government's way of, how the economy is going to prosper. And that in turn definitely impacts the businesses because they need to be cautious of the policies of the government in terms of what is it that the government is doing towards the greater good of the economic development of the nation. And how on a business level that impacts, we'll come to that. I think most of you are only aware of fiscal policy. Never heard of monetary policy, exchange rate policy, external trade policy. Never heard of these. Okay, let me give you a quick heads up on these before we actually dive into the aspects of it. A quick heads up. Just sharing the link with everyone in the chat box first. Okay, so what do we have? Let's quickly have a look. Okay, apologies. I think I need to share the sound again since I got disconnected last time. So I am just, okay, it's literally just starting off. The initial bit, he was just saying nonsense. So we can start here.
Let's start with monetary policy because it's not at all controversial. Well, it kind of is controversial, but it's less contentious than fiscal policy. Monetary policy is basically the way the government regulates the amount of money in circulation in the nation's economy. Controlling the money supply is the primary task of the Federal Reserve System, and since it's a little bit complicated, I'm going to talk about the other things that the Fed does first. The Federal Reserve System was created in 1913 to serve as America's central bank. Before then, there were state and local banks, as well as a Bank of the United States, which was a much more limited central bank. The Fed is made up of 12 regional banks and 2 boards, the Federal Reserve Board of Governors, who are appointed by the President, and the Federal Open Market Committee, which is partially appointed by the President. The Fed has 2 primary tasks, to control inflation and to encourage full employment. And it has 4 basic functions, but one of them is way more important than the others. The Fed is responsible ultimately for clearing checks and for supplying actual currency, most of which is kept in highly secure facilities staffed by robots with laser eyes. I don't know if they have laser eyes. The Fed also sets up rules for banks, although these can also be set by Congress. But the most important thing the Fed does is loan money to other banks and set interest rates. That's why when you hear about the Federal Reserve, 9 times out of 10 it's about interest rates, because that's the main way the Fed controls the money supply. The Fed loans money to banks. Sweet, sweet money, which they in turn loan out to businesses and individuals, and like all loans, the Fed charges interest. The Fed sets the rate on the interest, called the discount rate, and this determines mostly how much money banks will borrow. The lower the rate, the more banks will borrow, and the more money goes into circulation. Other banks peg the interest rates they charge to the Fed's rate, charging slightly more, so in this way the Fed determines or sets interest rates in the economy as a whole. The Fed also creates regulations that control how much money circulates in the economy. One of these is the bank reserve requirement, or the amount of money in cash that a bank has to have on hand. Now, the amount of money that a bank holds in reserve is only a fraction of the total amount of money held in deposit at the bank. That's why it's called fractional reserve banking. But the reserve requirement is there so that you don't get catastrophic bank runs like we saw during the Great Depression, when so many frightened depositors took their money out of the banks that the banks failed. Raising the reserve requirement reduces the amount of money in circulation, and lowering it pumps more money into the economy. The Federal Reserve also sets the interest rate banks charge to lend money to each other, which again controls the amount of money that circulates. If banks are charging each other a lot of money to borrow, they won't borrow as much, and they won't lend as much to firms and individuals, and there will be less money in the economy as a whole. There's at least one more important way that the Fed influences the money supply in the U.S., and that's through open market operations. This is a fancy way to say that the Fed buys and sells government debt in the form of treasury bills, or government bonds. When the Fed sells bonds, it takes money out of the economy, and when it buys them, more money goes into the economy. This is the idea behind what is known as quantitative easing, which is really complicated. To be honest, I'm not crazy about wading into economics here, and thankfully there's a whole other series to do that. But I have to mention inflation at this point. Inflation is a general rise in prices that can be caused by a number of things, but one of them is the amount of money that circulates. If there's more money around, there's more that can be spent, and this makes it possible for prices to go up. But this isn't an absolute rule. As of 2016, we've had years of basically zero interest rates, which means it's really cheap to borrow money, which means that there should be a lot of money in circulation, yet inflation remains quite low. Hey, it's real cheap to borrow money. Can I borrow $2? No? Never has any money. Usually, low interest rates tend to cause inflation and reduce unemployment, and high interest rates are expected to cool down an overheating economy, but that hasn't happened much in the past few years. I'll say again, I'm glad this isn't an economic series. It's important to note here that the Federal Reserve is an independent body, meaning that its board of governors and chairperson are not elected or really subject to much regulation from Congress. And they throw the best parties. That's probably why. This is intentional and probably a good idea. Ideally, you want people in charge of the money supply to be able to look after broader interests than their own re-election, and this is why the Fed is supposed to be insulated from politics and remain independent. Okay, so that's monetary policy, which is one lever that the federal government can use to influence the economy. Increasingly, it's the only lever because in America, we have a hard time with fiscal policy. What's that, you might be asking? Fiscal policy refers to the government's ability to raise taxes and spend the money it raises. Since I know that by this episode you've been paying a lot of attention to American politics, you know that in the past 20 or 30 years at least, Americans have generally been reluctant to raise taxes, and somewhat reluctant to have the government spend money. The difference between these two goals, spending money and not raising taxes, largely explains why we have deficits. Before we get into tax policy, which I know is what you've been waiting for, calm down, I need to point out that the way the government can spend more money on programs than it takes in taxes is by borrowing it, which the government does by, you guessed it, selling bonds. Good thing we talked about open market operations. Let's tax the thought cafe people with a lot of work by talking about taxes and spending in the thought bubble. First, ever since Ronald Reagan came to office, there has been a hostility towards higher taxes and government spending that is theoretically based in an idea called supply-side economics. I'm not going to discuss the details of the theory or even whether it's right or wrong or somewhere in between, but the basic thrust is that if you lower taxes on businesses and individuals, the individuals will be able to spend more, the businesses will be able to invest more, and the economy as a whole will grow. It's a simple and politically powerful powerful idea and has set the terms of the debate for a generation. In general, over the past 30 years, the trend is for there to be lower federal taxes and for them to be less progressive, meaning that wealthier people pay a lower percentage of their income in federal taxes. The wealthy still pay the largest share of federal taxes overall, though, so it's not completely accurate to say that they aren't paying. Since Reagan, and especially during the presidency of George W. Bush, income tax rates on the highest earners have fallen, as have taxes on estates, although they did go up again, and on capital gains and dividends. President Obama did raise taxes, but primarily on people earning above $450,000 a year. Corporate tax rates have also declined, and Social Security taxes have gone up, which is important because this is the federal tax that most of us are most likely to pay. Overall, the percentage of revenue that the federal government receives from taxes has held pretty steady at between 43% and 50%. If you're interested in the numbers, for 2013, the government received almost $2.8 trillion in tax revenues, and it spent $3.5 trillion, which math tells us means a deficit of around $700 billion. Thanks, Thought Bubble. When people say that they need to cut spending and balance the budget, this is what they're talking about, but it's not quite as simple as just spending less, because there are some places where the government can't cut spending even if they want to. There are certain items in the federal budget that must be spent because they're written into law by Congress. These are called uncontrollables or mandatory spending. One uncontrollable that relates to monetary policy is interest payments on federal debt. The government can't not pay its interest. Otherwise, no one would lend us money. That's just how lending works, or it's supposed to work. Farm price supports, subsidies, are also counted as uncontrollables, and they are important, but not nearly as important as the two big-ticket mandatory spending items. These are Social Security and Medicare, and they're paid for with dedicated federal taxes. They provide income and health insurance for elderly people, and it's unlikely that the amounts the government spends on them is going to decline anytime soon for three reasons. First is that the population is aging, meaning that the percentage of older Americans is rising in proportion to younger Americans. This means that more people will be receiving Social Security payments, which leads us to the second reason they are unlikely to go down. People like them. The third reason is more political. Older people tend to vote more regularly, so a politician who wants to keep their job is unlikely to vote for cuts in Social Security or Medicare. So here's the thing about the Federal Reserve and economics. The American economy is really huge and really complicated, and it has some issues that need addressing. Whether you care a lot about budget deficits or don't think they're a big deal will depend a lot on your feelings about economics in general, but there are a couple things to keep in mind. First, there's only a limited range of programs on which the government can choose to spend or not spend. These are called discretionary spending, and when people call for cuts in government spending, this is what they mean. By far, the largest chunk of government spending goes into defense, over $600 billion in 2013. But the next largest item is healthcare for the poor, Medicaid, at $498 billion. Nothing else even comes close. Spending on the Department of Education, for example, was $41 billion in 2013. The second thing to bear in mind is that in addition to cutting spending, the government could balance its budget by doing what everyone loves, raising taxes. It's done this on occasion, but the political consequences can be pretty tough. Just ask George H.W. Bush. Finally, the combination of Americans' aversion to raising taxes and the government's limited ability to cut spending means that monetary policy becomes its major lever in broad-based macroeconomic policy. That's why we paid so much attention to the Federal Reserve System at the beginning of this episode, and why you probably should too. Thanks for watching. See you next time. Crash Course Government and Politics is produced in association with PBS Digital
Okay, so that was one. I don't know why, but the volume of these videos have suddenly
Studios. Support for
declined a lot. Didn't used to be so bad. Just check if I can change. I mean, from my end, it's already showing maximum. Okay, let me just show you one more. I'll check the quality of the sound on this one as well. But nonetheless, I always put on the subtitles and would really want everybody to read through it, because the reason why I'm showing these videos is that it will help you quickly understand the concept and will always know if anything
Hi there.
we
When we're
see in audio visual, it just obviously stays with us for a very longer time. So that is why a quick one before we actually start with the topic. Let's have a look at this one.
studying the economic environment, in A-level business we'll come across a concept called fiscal and monetary policy. So let's just spend a couple of minutes explaining what it's all about. Don't forget, this isn't A-level economics. We don't need to know the detail of this aspect, just an awareness of what fiscal and monetary policy is. Well, fiscal policy is all about taxation and spending. It's what the government decides to do in terms of the taxes it levies on individuals and companies, as well as what it chooses to spend those taxes on, and whether or not it needs to borrow money in order to finance a budget deficit. So more on that in a minute. On the other side, monetary policy is all about the use of interest rates predominantly and other tools and tactics to control the amount of money in the economy and the cost of money, which is the interest rate. And that, as we'll see in a second, is controlled by the Bank of England. So just turning to fiscal policy, there are lots and lots of different taxes, but the three most important taxes that are levied by the government in terms of the amount that they raise are firstly income tax, which is a tax, as it says, on the employment income of employees and self-employed people. Corporation tax, which is a tax on the profits earned by businesses. And thirdly, VAT, or value-added tax, which is a tax that is levied on what we spend on goods and services. On the other side of the coin, with fiscal policy, the government spends our taxes. And the three main areas that it spends on are health, in particular funding the National Health Service, education, providing free education for certain years, all the way through to 18, and also supporting education beyond 18. And perhaps the biggest, social security, the vast majority of which is the payment of state pensions and related benefits. But other things go in there, such as unemployment benefits. Those are the three main areas. Obviously, the government also spends on areas like defence. And don't forget, it also spends on what's known as infrastructure or capital projects. The picture on the screen there is a major project currently ongoing, a little bit delayed, called Crossrail. So there we go, fiscal policy, the taxes the government levies and what it decides to spend them on. And of course, there's going to be a situation where the taxes that are raised are not enough to cover what the government wants to spend. So for example, here's some data for the UK. In 2018, it's expected that the total value of taxes raised will be £776 billion. However, the government would have spent £813 billion, which means that there is a deficit. Spending is greater than taxes, in this case a budget deficit of £37 billion. And the way the government funds that or finances that is by borrowing money, government borrowing, and therefore increasing the national debt. Okay, that's fiscal policy. Just a word on monetary policy. This is all connected really with interest rates, and there's a separate video on those to watch. The key point to remember about monetary policy is that it is controlled by the Bank of England, and in particular the Monetary Policy Committee, who meet each month to decide what the base interest rate should be in the UK economy. The main aim of the Bank of England is to try to keep inflation or price rises low within a target of 2%. But of course, they also look at the role of monetary policy in trying to support a sensible, stable level of economic growth. There we go then, that is just an overview, because that's all you need, of fiscal and monetary policy.
Okay, so that was just a quick heads up in terms of what is it that we will be studying in this chapter. So we will be having a look at the macroeconomic policies that the government prepares in order to achieve its macroeconomic objectives, which are what we've just done: stable growth, economic growth, less of, you can say, inflation, less corruption. We are looking at a more steady pace in which the economy per se is growing, and an equitable distribution of wealth. So let's have a look at each one of these various policies that you can undertake to achieve these objectives, beginning with the monetary policy. Now, monetary policy, what you really need to understand in this chapter is you will be asked like a 2-marker question in this chapter. So which will be talking about that what are the variables that revolve around a particular monetary policy. Just bear with me for a second, please. Right. So what do we mean by monetary policy? We are looking at the monetary variables like the rate of interest as well as the money supply in the economy. That are the 2 variables which we have to look at, and how the government is going to be able to influence the monetary variables in order to influence the demand and supply of money in the market. So rate of interest and money supply. I'll come to it in a detailed manner. Just let me introduce the terms to you as of now. Then we have a look at the fiscal policy. Now, the variables that we will be looking at under the fiscal policy are the amount of money that the government is spending as well as the amount of money that the government is collecting in the form of taxation. So government spending in terms of, investing more and more in building the infrastructure of the economy, in building schools, hospitals, bridges, all of that is government spending, as well as where is that money going to come from? Obviously, government is going to collect money in the form of taxes from the people as well. So both government spending and taxation is going to be ultimately impact the aggregate demand in the economy, and that is what we will study under the fiscal policy. Up next, we'll have a look at the exchange rate policy, which simply means at what rate is, you can say the INR is getting exchanged in return to US dollars, for example. So that is the exchange rate policy. So what factors influence the exchange rate of one currency in comparison to the other? And then we'll have a look at the government's external trade policy. Is it promoting exports? Is it putting a ban on imports? So what is the export-import policy of the government per se is what we will study under the external trade policy. 4 policy names you should know. The key variables under these policy names you should know. Right? 2 marker questions are definitely going to come in from this chapter. Let's have a look at each one of these policies in detail now. So 2 policies, two variables that we studied under the monetary policy are what? The amount of money in the circulation as well as the amount of the rate of interest being charged. That is ultimately going to impact the money supply as well as the demand for money. So the monetary policy basically talks about two variables which are there, that are the set actions taken by the government or the central bank, which is the RBI in India, to achieve the economic objectives using monetary instruments. 2 monetary instruments that we use here are the amount of money which is going to be in circulation. So how much rupees is the government literally, getting along and getting in circulation really? So what is the money supply in the economy, as well as attempt to reduce the demand for money by the use of rate of interest. Simple example here. What happens when the rate of interest on the funds that you're borrowing from the bank actually increases? What is going to happen to your demand? If the banks are charging a higher rate of interest on the loans and all that you're taking, the overall demand is going to decline, right? Because our total cost as a consumer is going to increase. So that is how the government is playing around with the demand and supply of the money via the use of the monetary instruments like the circulation of money as well as the rate of interest being charged, right? Yes, well done, Vani. So let's quickly have a look at what do we basically endeavor to achieve via the use of monetary policy as a government. We want growth in the size of the money supply. We want the level of interest rates to be moderate so that people can go ahead and actually take money on credit. The volume of credit or the growth in the volume of credit that we're looking at, as well as the volume of expenditure which is going to happen in the economy. So what is like the GNP of the economy, the gross national product of the economy. All of these are monetary policy variables, and these are the targets which the government endeavors to achieve via the use of monetary aggregators like the supply of the money and the rate of interest. 2 very important things that you should be familiar with, right? Now, monetary supply, how is it that you're targeting, the circulation of money in the economy? So the money supply as a target of monetary policy, obviously you will be looking at the amount of money that is in circulation with respect to the demand, the respective demand for the money as well. And that gets impacted by the requisite amount of interest rates that the government is charging via the principal bank, that is the RBI, right? So let's quickly have a look at this. The interest rate policy as well as the business. So now clearly, like I said, increase in interest rate is going to lead to what? So if the interest rate charged by the bank is rising, there are going to be fewer investments that are going to show you positive returns. Why? Because now you are borrowing at a cost of, say, 12% instead of the previous 10%. So you have to earn more than 12% to be able to break even on your cost, right? Because what has happened, the government has increased the rate of return. So there will be fewer investments, fewer projects that will actually show you a positive return. So that is something that is obviously going to happen. Obviously, it's going to exert a downward pressure on the share price. Why? Because what is going to happen, it is going to make it more difficult for the company to raise money via the issue of new shares. Why? Because the interest rates that needs to be paid for borrowing this money is going to be increased because the interest rates have risen, right? And obviously, when the cost is increasing, there is going to be decrease in the consumer demand, which is going to obviously result in squeezing of businesses. We are only going to stick to our basics and not probably, indulge in so much so of luxury goods. Why? Because there's a higher rate of interest that I need to pay to the bank to be able to get the money to be able to spend, right? Everybody okay with this? Any doubts in this? What happens and how the government is regulating the supply of money in the economy via the use of the monetary policy, the monetary tool of interest rates, as well as the amount of money in circulation, as well as the supply of money. Okay with everyone? Wonderful. So what happens when there is, what apparent problems are you able to identify in this monetary policy? Obviously, government implements the policy today, issues the policy today, but the impact of it is going to be not just from today itself, right? Slow and gradual process. So that time lag is definitely there. What else? Sometimes people just, again, regardless of whatever interest rates are going higher, people will still spend because they still want to indulge into that affluent lifestyle. Maybe people will, regardless of however amount of interest the government is charging via the banks, people will still take home loans because they want to, that aspiration of having your own home is always going to be there, right? So sometimes that linkage between the two is not direct. So because people will still actually, continue to maybe spend really. Increasing interest rate produces undesirable side effects. Why? Because now what is happening? It's basically leading to the fact that people are not wanting to spend. When people don't want to spend, it is going to, lead to a decline in the sale of industries and businesses, right? And ultimately, what businesses will do? They will, probably fire people. So it is going to lead to an increased unemployment as well. So that cycle is kind of vicious, right? So that is also one of the policy, one of the problems that we can identify with monetary policy and the increase in the interest rates. An overvalued currency which reduces demand for exports, because now what is happening is that your own currency, you're putting it at a higher pedestal than the real world would actually call out it to be. Let me quickly show you a quick video on this, just to quickly help you revise. So what are the two variables of monetary policy? I want everybody to quickly write it down in the chat box first. Two variables of monetary policy. Everybody please write it down in the chat box. So whenever you're talking about monetary policy, the two things that should hit your mind: rate of interest and money supply. Well done. What about others? I want everybody to answer, please. I want this to be, like fixated in your mind, because if you know the requisite variables and the policy they are referring to, you will be able to crack the marks that will be there from this chapter in your exam. Yes, that's right. I want everybody to answer, please. Quickly, everyone, pour in your answers while I show you a quick summary video on this.
Welcome to the Investors Trading Academy talking glossary of financial terms and events. Our word of the day is monetary policy. Monetary policy is one of the ways that a government attempts to control the economy. If the money supply grows too fast, the rate of inflation will increase. If the growth of the money supply is slowed too much, then economic growth may also slow. The actions of a central bank, currency board or other regulatory committee that determine the size and rate of growth of the money supply, which in turn affects interest rates. Monetary policy is maintained through actions such as increasing the interest rate or changing the amount of money banks need to keep in their vault. The term used is primarily used in reference to the US Federal Reserve, but has gained global recognition as central banks around the world react to the financial crisis and relied on actions by their specific banks to help the economic problems. The ECB has been in the headlines over the last few years as Mr. Draghi adopted monetary policy to help support the faltering Eurozone economy. The regulation of the money supply and interest rates by the central bank, such as the Federal Reserve Board in the US, in order to control inflation and stabilise currency. Monetary policy is one of the two ways the government can impact the economy. By impacting the effective cost of money, the Federal Reserve can affect the amount of money that is spent by consumers and businesses.
Hey everybody, I hope you're doing well today. In this video, we are going to take a look at exactly what is monetary policy.
Okay, so I think I've shown you enough videos to help you remember the two key variables that are going to be there in your monetary policy. And believe you me, if you know this, if you remember this, that's all you really need from your FM papers perspective. The next is your fiscal policy. Now, what were the two parameters that we had studied for our fiscal policy? Any idea? Any idea? I have already touched it very, very briefly in the introduction. Two variables, government spending as well as government income in the form of taxation. Yes, wonderful. So yes, that is exactly what the fiscal policy is all about. It talks about fiscal policy is action by the government to spend money or to collect money in the form of taxes with the purpose of influencing the condition of the national economy. Fiscal policy can be used as an instrument of demand management. So how much disposable income do people have left after having paid their taxes to the government? So that definitely impacts the demand side of the money. So monetary policy impacts the supply side of the money circulation. Fiscal policy impacts the demand side of the money circulation. Let me quickly show you a quick introduction video on this first. So yes, government income in the form of taxation as well as government spending is what we will be studying in the fiscal policy. Okay.
Today, we peer into a world where shadowy government stooges manipulate the levers of fiscal policy from deep in their evil lairs. They pick economic winners and losers and control the business cycle, creating recessions and controlling inflation to serve their nefarious purposes.
Nah, fiscal policy is a completely legitimate tool used by non-shadowy government officials to correct fluctuations in the economy. Okay, in previous videos, we've discussed the business cycle and how the economy goes up and down and up and down and up and down over time. This line represents the economy's potential GDP, the maximum sustainable amount that the economy will produce in the long run. But the business cycle shows that the economy isn't always at its potential. When actual output is below potential, economists call it a recessionary gap. Workers are unemployed and factories are sitting unused. Sometimes actual output can briefly rise above potential. Economists call this an inflationary gap. Unemployment is super low and factories are working overtime, but it's not sustainable. Eventually, producers will bid up the price of scarce resources and higher costs will lead to more inflation rather than more output. Obviously, real-life fluctuations aren't as predictable as the business cycle might suggest, but every modern industrialized economy has seen times of boom and bust. You know, you get your Empire Strikes Back and you get your Phantom Menace. So look at the real GDP growth rate in the United States since 1920. See, up and down over time. In the mid-1980s, things flattened out, and we had a thing called the Great Moderation. It seemed like the days of deep recessions and high inflation were over. Then came the Great Recession as a result of the 2008 financial crisis. Back to the same old up and down of the business cycle. Both recessionary and inflationary gaps cause serious problems. High unemployment when the economy is bad, that's bad, like really bad. And not just for the economy, for people. High unemployment rates have been linked to higher suicide rates, more domestic violence, and social upheaval. High inflation can be just as bad. Rising costs wipe out savings and have been the root of protests and riots throughout the world. Well, this seems like a fun episode. Stan, what's with all the doom and gloom? Isn't there some way to smooth out these fluctuations? I'm going to answer my own question. There might be. Many economists argue that policymakers should intervene in the macroeconomy in order to promote full employment or reduce inflation. Today, we're going to look at one of the ways to do this: fiscal policy.
The idea of fiscal policy is really simple. When the economy is going too slow or too fast, the government can step on the gas or the brake by changing government spending or taxes. In the United States, that's the job of Congress and the president. When the economy falls into a deep recessionary gap, the government can increase government spending, cut taxes, or do some of both. That's called expansionary fiscal policy. The idea is that government spending creates jobs and increases incomes for construction workers and teachers and other laborers. In turn, these workers spend more of their additional income, increasing consumer spending and boosting the entire economy. Cutting taxes follows a similar logic. A tax cut will increase disposable income for consumers. That'll increase their consumer spending and boost the entire economy.
This is exactly what the U.S. did in 2009, during the depths of the Great Recession. The American Recovery and Reinvestment Act was a stimulus bill that added more than $800 billion to the economy. That stimulus was split 60-40 between new government spending and tax cuts. And the expansionary fiscal policy funded new roads and bridges and upgrades to the electric grid. And those projects created jobs.
But when the economy has an inflationary gap, the government can cut spending or raise taxes or do some combination of the two. That's called contractionary fiscal policy, and that's not half as fun. The idea is that higher taxes will leave consumers with less money to spend, and lower government spending will mean fewer public jobs. All that should reduce consumer spending, cooling off the economy and reducing inflation.
We don't see contractionary fiscal policy very often in practice because politicians rarely want to hit their voters with a slower economy. It's a hard sell, and it could cost policymakers their job. U.S. President George H.W. Bush famously stated, "Read my lips, no new taxes," while campaigning in 1988. A few years later, he agreed to raise taxes to reduce the debt and lost the election in 1992. So the big question here is, does fiscal policy actually work? Does stimulating the economy with spending and tax cuts actually, make the economy grow? That is the most heated debate in modern economics, and it's been raging for decades. It's been known to drive mild-mannered economists to use their loud voices on cable news shows. Let's learn about it in the thought bubble. Classical theories assume that the economy will fix itself in the long run, and that government intervention will at best lead to unintended consequences, and at worst cause massive inflation and debt. These theories dominated policy decisions during the early years of the Great Depression, which saw little stimulus. Economists argued that unemployed workers would eventually accept lower wages, since some pay is better than no pay, and resource prices would eventually fall since fewer people were using resources. Lower costs would lead to more production, more jobs, and poof, the economy is back on track. At the time, many policymakers thought about a sick economy the way doctors 1,000 years ago thought about a sick patient. The thinking was that problems resulted from accumulated imbalances, which could be cured by aggressive purging. In the case of doctors, that meant bleeding their patients. In the case of a recession, that meant standing back and letting the economy bleed jobs and output until balance was restored. Then entered British economist John Maynard Keynes, one of the most influential and controversial economists of the 20th century. Keynes basically invented modern economics and developed theories and models about spending and production. He is the one that suggested using expansionary fiscal policy to speed up the economy. Keynes argued that government spending can make up for a decrease in consumer spending. So even if the economy does self-correct in the long run, there's no reason to wait it out. His justification? In the long run, we're all dead. Well, Keynes died in 1946, but his theories live on, and so does the debate.
Thanks, Thought Bubble. So at first glance, Keynesian policies seem like the perfect solution to fixing a sluggish economy. If consumer spending falls, the government can spend instead. What's the harm in that? Well, the government needs to pay for all that spending. They can't just raise taxes to cover it because that would decrease consumer spending and defeat the purpose. So to stimulate the economy, the government needs to deficit spend. They need to spend more money than they collect in tax revenue. Now, to achieve this, the government needs to borrow money, which will result in debt. Now, we're going to make a video about the national debt and different schools of economic thought, but for now, it's fair enough to say that the people who don't like Keynesian policy don't like it because it causes debt. A more technical argument against deficit spending is that it leads to something called crowding out. If the government borrows a lot of money, that increases interest rates, making it harder for businesses to borrow money and buy things like factories and tools. This weakens the economy while increasing government debt. But Keynesian economists maintain that crowding out is only a problem if the economy is operating at full capacity, where all workers are employed and we're producing as much as we can. In that case, since total output can't really rise, more government spending will result in less private spending. However, they argue the situation is different when the economy is below capacity, with lots of unemployed workers and vacant factories. Now, in that case, more government spending can raise overall output by putting idle resources back to work. In fact, Keynesians would argue that government stimulus when the economy is below capacity can actually raise private spending. All those newly hired workers will start spending more money.
So how can we figure out who's right? We can start by comparing the actual performance of economies that received stimulus to those that didn't. As we mentioned, in 2009, the US government launched a huge stimulus program in response to the financial crisis. Despite that, employment and GDP both fell. That sounds like a failure, but the majority of economists think that the situation would have been far, far worse without that stimulus. And while the US was implementing stimulus, most European countries were doing the opposite. They were pursuing a policy called austerity, raising taxes and cutting government spending to reduce debt. Since 2011, when the US and European policies really started to diverge, the US economy has grown at an average rate of 2.5%, while the Eurozone GDP actually shrank by 1%. US unemployment fell to 5.5%, while Eurozone unemployment rose to 12%.
Another thing to keep in mind is that stimulus is complicated and it's hard to do well. One reason is because of this thing called the multiplier effect. The idea here is that the government spends $100, then the highway construction worker who got the money will save 50 and then spend 50 on a concert or something. The musician who got that money will save $25 and spend the other 25 and so on. So because of this ripple effect, the initial increase in government spending of $100 might turn out to be $175 worth of actual spending in the economy. Economists would call this a multiplier of 1.75. But the question is, what's the real multiplier in the United States economy? Economists have come up with a wide range of estimates for that multiplier, but it turns out it depends on different situations. When the economy is already booming, the multiplier seems to be close to 1. If everyone's already working and the government wants to build a road, then they're going to have to hire workers away from the private sector. Sure, public sector output increases, but private sector output falls and GDP is unchanged. It's a wash. But when the economy is in a recession with lots of unemployed workers and a lot of unused capital, the multiplier is around 2. Through that ripple effect, an increase of $100 of government spending will lead to about $200 of total spending, which puts some people back to work. Moreover, different policies have different multipliers. Spending on welfare and unemployment seem to give us the biggest bang for our buck, since people with low incomes are likely to spend virtually all of their additional income. Spending on infrastructure and aid to state and local governments also seems to have a fairly high multiplier of about 1.5. But general cuts to payroll and income taxes seem to have a multiplier of about 1. If the government cuts $100 in taxes, the economy is going to grow about $100. More targeted tax cuts and tax credits have lower multipliers since they tend to benefit those with higher incomes who often save rather than spend additional income. But what we want is something that will affect the economy rapidly, but also have a high multiplier. So tax cuts put money in people's hands quickly, but that money might get saved rather than spent. On the other hand, infrastructure projects like making roads and bridges have strong multipliers, but it might take months or even years to complete. So fiscal stimulus may be an important tool, at least when it comes to a recession, but it doesn't mean that it's easy to do or that all stimulus is created equal.
So fiscal policy has its advantages and drawbacks, but in the end, maybe it's all about that thing you didn't have when you were in 6th grade. Confidence. When people are miserable and unemployed, they want to feel like help is on the way. Doing nothing doesn't create the kind of confidence that will get consumers and businesses spending again, and it doesn't get politicians reelected. So it looks like Keynesian policies are here to stay. Unless...
Crash Course Economics is made with the help of all of these nice people.
Okay, the reason why I showed you a crash course was that is actually the maximum you really need to know from your FM's perspective on the topic of monetary policy as well as fiscal policy. So let's quickly have a look at the problems that you are able to identify when the government increases demand. So problems with government increasing demand, is that a problem? So government is increasing demand. So ideally it should be a good thing, isn't it? However, when government spending in an intervention into a free market, it can lead to misallocation of resources. Why? Because it is going to happen that what is the government doing by increasing the demand? It is trying to support maybe inefficient industries within the economy. So it's always not a good thing to intervene into the free flow of the demand and the supply of the money in the economy. There is often a significant time lag, obviously, between, authorizing a policy and actually getting it implemented. Tax cuts are not efficient at boosting domestic demand. Why? Because what is going to happen at the time of recession, whatever extra disposable income people had, what are they going to do with it? They are obviously going to make it available to be saved, and some of the extra money actually spent will be on imports instead. And a large budget deficit is likely to occur. Why? Because what is happening now? More and more imports are happening. However, it is not getting balanced by sufficient amount of exports happening into the economy as well. So exports, you should be able to sell your locally produced goods and services in other countries outside your own country. The rate of inflation is definitely likely to rise and demand may increase for resources which are in limited supply. And when demand is going to increase, obviously the requisite price is also going to increase, right? Okay with everyone? So two variables of your fiscal policy. And are there problems associated with intervening with the free flow? Yes, there will always be problems associated with if the government intervenes with the free flow of demand and supply of money in the economy. Decreasing demand, is that a good thing? Obviously, everything has its own set of pros and cons. It is not possible to cut government spending dramatically on sectors where the people expect the government to spend. So the government cannot stop spending on, on healthcare, on infrastructure building, on education being provided in the government hospitals. That is something which definitely the government cannot help but do. Increasing taxation, that discourages enterprise in the form that when there will be higher taxes that need to be paid to the government, it will not encourage a very entrepreneurial culture. It will discourage people from doing their own startups, because they will feel that, okay, 50% of what I'm going to earn is going to be given to the government. So is it really worth taking that risk or not? So increasing taxation again discourages enterprise. Okay with everyone? Everybody able to understand this? Any doubts in this? Quick revision video is what I'm going to show you now. And believe you me, when you will do question practice on this, that is the time you will actually get confidence on this topic.
Hi there.
Very, very
When
simple questions are going to be asked. Nothing more than, like literally being able to identify the variables of a particular policy, really. So let's quickly have a look at a quick summary video on this.
The economic environment, in A-level business, we'll come across a concept called fiscal and monetary policy. So let's just spend a couple of minutes explaining what it's all about. Don't forget, this isn't A-level economics. We don't need to know the detail of this aspect, just an awareness of what fiscal and monetary policy is. Well, fiscal policy is all about taxation and spending. It's what the government decides to do in terms of the taxes it levies on individuals and companies, as well as what it chooses to spend those taxes on, and whether or not it needs to borrow money in order to finance a budget deficit. So more on that in a minute. On the other side, monetary policy is all about the use of interest rates predominantly and other tools and tactics to control the amount of money in the economy and the cost of money, which is the interest rate. And that, as we'll see in a second, is controlled by the Bank of England. So just turning to fiscal policy, there are lots and lots of different taxes, but the three most important taxes that are levied by the government in terms of the amount that they raise are firstly income tax, which is a tax, as it says, on the employment income of employees and self-employed people. Corporation tax, which is a tax on the profits earned by businesses. And thirdly, VAT, or value-added tax, which is a tax that is levied on what we spend on goods and services. On the other side of the coin, with fiscal policy, the government spends our taxes. And the three main areas that it spends on are health, in particular funding the National Health Service, education, providing free education for certain years, all the way through to 18, and also supporting education beyond 18. And perhaps the biggest, social security, the vast majority of which is the payment of state pensions and related benefits. But other things go in there, such as unemployment benefits. Those are the three main areas. Obviously, the government also spends on areas like defence. And don't forget, it also spends on what's known as infrastructure or capital projects. The picture on the screen there is a major project currently ongoing, a little bit delayed, called Crossrail. So there we go, fiscal policy, the taxes the government levies, and what it decides to spend them on. And of course, there's going to be a situation where the taxes that are raised are not enough to cover what the government wants to spend. So for example, here's some data for the UK. In 2018, it's expected that the total value of taxes raised will be £776 billion. However, the government would have spent £813 billion, which means that there is a deficit. Spending is greater than taxes, in this case a budget deficit of £37 billion. And the way the government funds that or finances that is by borrowing money, government borrowing, and therefore increasing the national debt. Okay, that's fiscal policy. Just a word on monetary policy. This is all connected really with interest rates, and there's a separate video on those to watch. The key point to remember about monetary policy is that it is controlled by the Bank of England, and in particular the Monetary Policy Committee, who meet each month to decide what the base interest rate should be in the UK economy. The main aim of the Bank of England is to try to keep inflation or price rises low within a target of 2%. But of course, they also look at the role of monetary policy in trying to support a sensible, stable level of economic growth. There we go then, that is just an overview, because that's all you need.
Okay, so that was just a very quick overview of what is required from your FM's perspective. Now, I will not go any further. It's time to wind up the class today. I think we've literally gone ahead and, finished the entire duration of the class today. But what I want you to do over the weekend is revise the entire chapter 1 that we've done and little bit of chapter 2 that we have just started, because in the next session, we will be finishing off with part B of your syllabus. There's this chapter, one more PPT slide is there, and then we'll hop on to question practice, right? But till then, please practice what we have done till now. So chapter 1 is definitely something that you can get rid of before you come for the next class. I know we've done each and every question in the class, but don't just rely on what we've just done in the class. You have to sit down and do all these questions again by yourself as well, right? Okay, then thank you so much everyone for joining in, and I shall see you next week. Thank you. Bye-bye.